After knowing the 3 life decisions with huge impact on your finances, as well as the 10 money tips for 20-somethings, let's now move on to understanding what the basic principles of investing are. The basic principles of investing means that you need to put your financial house in order, budget diligently, and save regularly. You also need to know yourself first. Know your financial condition, your financial goals, and risk tolerance. Develop a long-term plan for your personal investments. Investigate before you invest. Start investing early. Develop the right attitude when investing, and get the right help if you need any. Those are the basic principles of investing. Investment pitfalls. These are ignorance of the investments made, procrastination in making an investment, having no specific goals attached to an investment, lacks discipline, patience, and commitment in regularly investing, did not consider transaction costs prior to investing, timing the market was the focus instead of being in the market through dollar cost averaging, following hot investment tips without analysis when making an investment, buying when prices are too high, falling in love with an investment even if the investment is already losing value, ignoring an investment by not monitoring it, lack of diversification on your investment portfolio. These are the investment pitfalls you should avoid. Factors that reduce risk. Your role in an investment process is very important. As such, you need to evaluate potential investments, monitor the value of your investments, keep accurate and current records of your investments, consider the tax consequences of selling your investments, and seek the assistance of a financial advisor. Sources of investment information are likely as equally important. You need to know and analyze the financial statements and annual reports of the companies you've invested in. Use the internet. There's a wealth of investment information available there. You use the newspaper and news programs, business periodicals and government publications, investor services, newsletters, and financial calculators. After knowing the basic principles of investing and avoiding the investment pitfalls and understanding the factors that can reduce the risk in your investments, you're now prepared to know your personal plan for your investing. Number 1, establish realistic goals. Number 2, determine the amount of money needed to meet your goals. Number 3, specify the amount of money available to fund your investments. Number 4, list different investments you want to reevaluate. Number 5, evaluate risk and potential return for each investment. Number 6, reduce possible investments to a reasonable number. Number 7, choose at least 2 different investments. And number 8, continue to evaluate your investment program regularly. We now go to finding out what are the 5 important decisions you need to make in order to succeed in your investments. The choice between do-it-yourself versus seeking professional advice. It may not be prudent when it comes to investing if you want to do it yourself, considering that our natural instincts are our worst enemy when investing. We tend to buy stocks and bonds after prices have risen, and when there's a downturn, fear sets in and we are quick to sell. But as for seeking a professional advice, this means that a financial advisor will provide a roadmap for your financial plan. He or she will bring the discipline and clarity into the investment process. It will also help you avoid behavioral traps, such as overconfidence or attraction to rising prices or herd mentality. But what type of an investor is best? Take a look at the investment philosophy and making sure that you think about investing and markets being the same as you. Personal connection and trust is also important. Understanding your feelings about money, your goals, dreams, and aspirations. Check out his professional designation as well, and if this person also has the right education and experience. Asset allocation decision. We've already known that this is how you're going to allocate your investments among stocks, bonds, and cash. It's also the most important investment decision you will make because it will have a big impact on your investment returns. Therefore, taking into consideration that the primary driver of investment returns is also risk. Diversification decision. Which asset classes within the broad category should you include in the portfolio and in what proportion? If you don't have the time, training, and tolerance, you should hire a financial advisor. And by investing in the likes of, let's say, mutual fund, endowment, VUL, you should be hiring a money manager. Active versus passive decision. We already found out that if you have to favorably actively manage the investment, then you should seek to outsmart the market. Or perhaps the passive approach is better for you because it will deliver market-like returns. The thing that is important to remember here is your portfolio risk versus its return. Rebalance decision. When should you sell certain assets and when should you buy market? This is the automatic way to buy low and sell high without your emotions getting in your way. It also allows you to put back your portfolio to its original asset class percentage. 8 steps to managing a financial crisis. One is to establish a larger than usual emergency fund. This means having more than 6 months to even a year worth of your monthly expenses. And therefore, you also need to, number two, know what you owe, because this might mean that you might be not paying and incurring more penalties and late charges. Number three, reduce spending. It means having to live within your means so that you avoid having to incur debt. Number four, pay off your credit cards as they fall due. Otherwise, you will keep on paying additional interest for not paying the complete amount that is due. Number five, apply for a line of credit. This is only possible if you've kept a good credit record. But if your credit is not good, it might be hard for you to get a line. Number six, notify credit companies and lenders if you're unable to make payments. This is a good rule to follow because it will show that you are serious in wanting to pay, but are currently not able to do so because of certain liquidity concerns, but you're also asking for a certain lengthening of the time with which you can pay up. Number seven, monitor the value of your investment and retirement accounts. So as mentioned, when we were talking about the investment plan, this has to be regularly monitored. At the same time, the strategy you've adopted should be implemented, and therefore it's part of wanting to see whether you should keep your investments or already cash them out. And number eight, consider converting investments to cash to preserve the value. There's also such a thing as what you call having to take in the profits based on your policy targets and at the same time wait out till it has corrected for you to come in again. So to keep it there long term is fine, but you should regularly see to what extent you should be now cashing it in order to just preserve the value. So these are the 8 steps to managing a financial crisis and how you can overcome it. Thank you.